Dear all, MeDirect thanks you for joining this webinar, the 20th in our MeDirect Talk series. During these sessions, we feature several financial experts and asset managers sharing their views on markets and investment opportunities. MeDirect has always been at the forefront of providing you with the latest on the investment world, and we aim to continue doing so through our regular updates on our website and social media. Our team of experienced wealth advisors are also always available to assist you. Today, joining us, we have representatives from BlackRock, a multinational investment management corporation based in New York. Founded in 1988, initially as a risk management and fixed income institutional asset manager, BlackRock is nowadays the world's largest asset manager. This time around, we wanted to discuss the outlook in three key investment sectors: technology, healthcare, and financials. And we will in fact be the focus of this event. Joining us today is AJ Ziegler, Vice President and leading Product Strategist within the Active Equities Group at BlackRock, representing global, sector, and thematic equity strategies. Towards the end of this event, we will have a Q&A session. I invite you all to submit any questions you might have throughout the presentation through the Q&A or chat functions which you can find at the bottom right of your screens. Matthew Kilroy, Vice President within the BlackRock team, will start the event by giving a brief introduction. Matthew, over to you.
Thank you very much, Ingrid. Welcome, MeDirect clients. It's a real pleasure to be seeing you all, even virtually, of course. But as Ingrid mentioned, we'll be talking about some very important themes that will characterize not only the way we invest in the coming months and years, but most importantly, the way we live. So with that being said, I would like to give all the space and time that is needed to our AJ Ziegler directly from the investment team that manages our funds that invest in the three themes of today: technology, healthcare, and financials. AJ, if you can hear us, over to you.
Thank you, Matt. Thank you, Ingrid. And thank you to everyone for making time for this call this afternoon. It's a really exciting time to be talking about these sectors. There's a lot of uncertainty in the markets, and what we wanted to present today is to discuss some of the opportunities and potential risks across three of the most talked about sectors of technology, healthcare, and of course, financials as well. So without further ado, the way I wanted to start is to kick it off right with technology. Out of all the different sectors, it would be difficult to argue that any other sector has made such an impact on our daily lives, the way we work and interact, than tech. But from an investment perspective, let's keep in mind, this is the largest sector in the world. And if you look at the next slide, you're looking at a sector that has over 2,600 companies around the globe, representing over 27 trillion in market cap. It is absolutely enormous. And the driver behind this growth, if you look at over the past 20 years, technology has delivered the strongest returns and has really been the driver of equity markets for 2 decades. So as a result, what that means for clients and investors is technology has really become a more important part of an overall investor portfolio, more so than ever before. But because of its size and breadth, we believe it's very important to understand, which areas could have the potential best opportunities and which areas could be very much poised for disruption. And if we take a look at the next slide, what we want to demonstrate is really thinking about how technology has really reshaped the entire global economy. And we highlight just a few of the investment themes that we're looking at within our portfolios today. First off, think of electric vehicles. Everyone knows, the large players such as Tesla, but this is a theme that has a far greater amount of complexity behind it. Think of the entire supply chain. It's more than just the manufacturers. It's also about the batteries, the components, the parts, the charging. All of that creates a vast amount of investment opportunities. And when you think about EVs, this is an area where penetration is still relatively low and we believe has a long way to grow. Not only that, when you think about the components of parts in the middle part of this slide, think about the semiconductors. Electric vehicles contain about double the amount of semiconductor content than traditional vehicles. So as the world transitions more to electric vehicles, it's going to increase substantially the demand for semiconductors as well. And another theme I'd want to highlight is one that has grown tremendously quickly in popularity, and that's generative AI. Thinking about artificial intelligence and how it can make such a dramatic impact on all areas of our lives. I'm sure many of you have heard of ChatGPT, and for those of you that may have children in school, they probably know all about it, using ChatGPT to help write their papers and source new content. It's truly an extraordinary technology that's really in its first innings. You look about the explosive growth in just 2 months. We're really only scratching the surface in terms of the capabilities of artificial intelligence, and most specifically generative AI. And then there's also some core themes of tech that have seen a lot of growth during the COVID pandemic, but we believe that growth will continue. Think about cybersecurity. Cybersecurity had a huge boom during the COVID period, more businesses going remote or virtual, and that just leads to a greater demand or increase for cybersecurity. Think about fintech. The way we go about paying for goods and services. During the COVID pandemic, you saw numerous countries raise the limit on contactless payments to help encourage that shift of traditional cash and coin to digital payments. This is an area that's received a huge amount of funding and is massively disrupting traditional financial services, from the way we bank to the way we pay. And then also there's these new emerging themes that are still, very, very early stage, such as space and space tech. So this is how we think about tech reshaping the entire global economy. And our approach, from an active perspective, is we invest across all of these different themes that are reshaping the landscape. And maybe just to touch on our technology outlook on the next slide, what do we expect for the coming 12 to 18 months? Well, firstly, on the top, we anticipate it's likely going to have some continued volatility in the short term. There are some potential headwinds that still persist in today's market. However, we believe what that could lead to on the second part is a significant technology rebound. Historically speaking, after a period of rising rates similar to what we've been experiencing over the last year, is technology usually is quick to rebound. And with valuations very low, I'll talk a little bit later about some of the areas that we believe could potentially lead this rebound. And then also new secular themes are emerging. That's the long-term story. You think short-term potential volatility, second half, potential rebound, but there's this longer-term story about these long-term structural themes that are going to be ever more present in our daily lives. So to touch on these, just on the first part, what do we mean by some of the potential short-term volatility? If you flip over to the next slide, there is still some uncertainty revolving around inflation or the path of interest rates. That's really what's impacted technology markets in 2022, and some of those headwinds may still persist. And if you flip over to the next slide on slide 10, what we show also in that second part, or sorry, one earlier slide, is also the demand picture for tech still hasn't fully recovered, and that's something we're actively monitoring. But one area that is looking quite encouraging is the rebound in China tech after years of a harsh zero COVID policy. We believe this is an area, a huge market, that is finally going to be positioned for that long-awaited recovery after many years of harsh COVID lockdowns. So the second part to that outlook, that potential recovery, if you flip over to the next slide, in 2022, valuations for technology came back down to pre-pandemic levels. But in some areas, such as the internet subsector, valuations dropped all the way down to a point that we haven't seen in nearly a decade. Now, this is a valuation chart, so looking at enterprise value to revenue multiples, so basically just a gauge of valuations. The higher the chart, the more expensive, the lower the chart, the more cheap. And as you can see, valuations for the internet subsector are at 10-year lows. And it's our belief that if we see a rebound in broader tech, this is an area that is very well positioned to recover, not just because we anticipate it's an area that could see stronger demand, but it's an area that has priced in so much negativity that if sentiment were to reverse, this is an area that can materially benefit. And then thirdly, I just want to highlight a couple of the new secular themes that are emerging on the next slide. The biggest one is generative AI. It's hard to understate how excited we are about this theme. The applications seemingly are limitless. From text to image to voice recording, using generative AI to create new content. And we're still so much in the early beginnings. Right now, how we're thinking about investing in this theme is largely on the infrastructure. So think about the semiconductors that need to, help supply that computing power. That's where we've really increased our investment. And later on, as the years goes by, we're going to see more and more consumer use cases. And whenever you're using, AI technology, so let's say it's ChatGPT, always think to yourself, when you're using it today, this is going to be the least sophisticated it will be at any other future point, because it's only getting smarter. So what you use today, tomorrow is going to be even better, and tomorrow even more sophisticated after that. And that's what gets us so excited about that theme. And then also another theme, onshoring or reshoring, bringing supply chains back onshore. This is a huge theme that's really triggered from geopolitical tensions or COVID, bringing those supply chains back onshore. Thinking about the CHIPS Act in the US, hundreds of billions of dollars of funding, to bring semiconductor manufacturing back onshore. So these are very long-term themes that we believe are going to continue to influence the tech market. And I'll conclude technology with one last slide on the next slide, just showcasing our capabilities for tech. This is such a massive universe. We have a dedicated investment team, primarily based in San Francisco, which is really the heart of Silicon Valley. And what we aim to do is implement an investment approach that's one, very broad and diversified. Investing across over 100 different stocks, multiple different themes within tech, and also having a balance between some of the core established larger tech names, but also giving exposure to some of the smaller mid-cap hyper-growth names in tech. And what we aim to do is apply a deep understanding of these technology names and then construct them in a diversified portfolio that our clients can invest in to get direct access to a diverse slate of these exciting, innovative themes that we believe are going to be driving the tech sector and driving equity markets over the long term. So with that, I'll take a pause on technology. So
AJ, if you like, feel free to go ahead into healthcare.
Sure thing. And to transition it to another sector on healthcare, a lot of times when we interact with clients, they get very excited about the tech themes, the growth and innovation. But for other clients, maybe they're seeking something a bit different, seeking resilience in equities, maybe worried about the macro picture, worried about rates and inflation and geopolitical concerns. And the one area where we would suggest to take a look at, if you're seeking resilience in equities, it's healthcare. And the number one reason why is that when you think about the driver of returns for different sectors, every sector has its driver. For energy, it might be the oil price. For financials, it might be rates. But for healthcare, it's really about just people getting older and living longer. And if you flip over to the next slide, the number one driver behind healthcare, it's aging demographics. Now, think about the US. By the end of the decade, it's estimated a fifth of Americans are going to be over the age of 65. When you hit that threshold of 65, that's the point in time where you're about to spend 3 times as much on healthcare relative to anything you've spent on healthcare previously. So you got this demographic shift where people are getting older, and this is the fastest growing demographic, age over 65, which is really the fuel for healthcare. And this is a trend that is likely to continue regardless of the economic environment, regardless of rates or inflation or geopolitical tensions or whatever you may consider. People are still getting older and living longer, and that is great for healthcare. Not only that, if you look to the far right, some of the most populous countries in the world, China and India, spend just a fraction of GDP on healthcare relative to developed markets. And we believe that'll change over time, and just another element of fuel, for healthcare. So if you're looking at this sector, this demand growth, what does it really get you as the investor? Well, one thing it can get you is flip to the next slide. Healthcare has a history of downside mitigation relative to equity markets. Simply put, if you look at this bottom right chart and all the big drawdowns that equities have seen over the past 30 years, healthcare, time and time again, has provided more resilience. So if you're looking for potential downside protection, and of course, past performance is no indicator of future returns, but healthcare does have this history because the demand growth is far less correlated to macro factors. It's more correlated to just people getting older. It's able to provide that downside protection. So that's the demographic benefit of healthcare, but there's another element as well, and that's innovation. And that's what we show on that next slide. All of these themes for the coming decade, over the past couple years, when you think of healthcare, you typically think of COVID and vaccines. And of course, that's understandable. COVID had a massive influence on our lives and on the markets. But what got overshadowed is some of this exciting innovation in healthcare that really isn't, related at all to COVID. It's more related to, solving some of the problems when it comes to improving health. And this could be an array of themes, and we invest across all of these different types of themes. Whether it's oncology, think about more sophisticated ways of treating cancer. Whether it's next-gen diagnostics, utilizing this great genome analysis that's been developed over the years to have better and also cheaper potential treatments, for genetic diseases. Also, it could be areas like robotic-assisted surgery. Think of this theme which 10, 15 years ago was hardly existed, but this is a bit of the marriage between tech and health. If you're thinking about robotic-assisted surgery, think about, elective procedures, so knee or hip replacement surgeries. Think about how this process can be so much more sophisticated with the use of technology and robotic-assisted surgery. Having a very sophisticated 3D preoperative plan, using technology to determine the exact and most optimal place in a patient on where to make that incision, to conduct that surgery. And what it's done is it's created a way where there's less risk of error. There's typically a faster recovery time. And then also for robotic-assisted surgery, bring it back to demographics, people are living longer. The chances of people needing a knee or hip replacement surgery have increased substantially. So these are all different types of themes that we're very excited about for the long term, and even biosensors and trackers. Just think about more sophisticated ways to, let's say, to track glucose levels, in people, rather than taking a finger prick and a blood sample, just holding up a sensor up to your arm. Now, all of these themes are coming back to the forefront. And we believe they're going to influence and drive the healthcare sector for the coming decade. Now, you may be thinking, a lot of this sounds very positive, right? You got aging demographics, you got a sector that has a history of providing downside protection, all of these themes. You may be wondering, what about valuations? Well, if you look at the next slide, valuations for healthcare are actually trading at a discount relative to the global equity index. So all of these potential benefits you get really without paying a premium. So if you're thinking about an entry point, it'd be hard to argue, you're definitely not overpaying for this type of exposure, where valuations are today. So to wrap up on healthcare, just to showcase the next slide on our capabilities at BlackRock, we run, about 29 billion in AUM in healthcare strategies. And the next slide just shows a quick snapshot of what we aim to deliver. We have a dedicated team based in Boston, that brings an average of 20 years of experience on science and investing. And because healthcare is very nuanced, very, specialized type of sector, we bring in, a very specialized investor type, to make the best of that. We have 5 PhDs on the team in areas of biochemistry, chemistry, molecular medicine, to really understand the science behind the products of the companies that we're investing in. And the team is very hands-on. On the top right, we do over 1,000 company meetings per year. Due diligence can be directly with physicians or analyzing directly the clinical trial data. And also our approach, it's very diversified yet flexible. And the reasoning behind that is it's our belief most clients, or most investors, I should say, look to healthcare for the potential of resilience and consistency of return. And that is exactly what we aim to deliver as well. A balanced approach, yet flexible for changing market environments, to offer a way to get exposure to healthcare through investors that can deliver that element of industry expertise. So with that, I'll conclude with healthcare. I'm happy to transition to the one last sector I want to talk about today, which is financials. And to kick it off on the financial sector, this has certainly been, quite newsworthy with the disruption with some of the banks in the US and also in Europe. But to take a step back, think about, why is now a potentially interesting time for financials? And if you flip over to the next slide, well, firstly, consider this is one of the cheapest sectors relative to the MSCI ACWI. Now, within the broader global equity index, this is a sector that trades at a substantial discount. Not only that, it's an area where you can see higher than average dividend yields relative to the global equity market, especially in the banking sector, in the US and in Europe, where you can see a material, premium on those dividend yields. Also, the interest rate environment, considering here in Europe, there's been a huge period where you've had low and even negative interest rates. Well, how interest rates, have rocketed upwards. This is one of the most highly correlated sectors to rising interest rates. Banks will typically do better, in a higher rate environment, and that's what we've entered into. And then also you have areas of emerging markets which are still largely underpenetrated, for financial services and trade at a notable discount. And lastly, as a kicker, if 4 reasons aren't enough, we added a 5th, and it's exposure to fintech disruption. I alluded to this a little bit in the beginning within technology, but from an earnings standpoint, financials is one of the largest sectors in the world in terms of earnings. And it's also facing one of the biggest disruptive forces of technology that has disrupted many other sectors, and financials isn't immune. But we see this as actually a strength where we can invest in some of these disruptors that can best utilize, technology within their business. But to dive into this a little bit more on the next slide, I just wanted to highlight the relative valuations of financials on the next slide. You're looking at the second cheapest sector in the index, and put this in the context of financials historically, does very well in a rising rate environment or a period of higher rates. Well, that's what we've seen, and financials has done well, but it's still trading at a significant discount relative to the MSCI equity. And also the other thing I wanted to highlight, in addition to the valuations, is the opportunity in fintech. And if you can flip over to the next slide, this is what we're talking about. We talked about the marriage of tech and healthcare, but what about the marriage of tech and financials with fintech? Think about digital payments. I'm guessing many of the audience members on the call think about how much more you use digital payments today than 5 years ago. It is a substantial change. And globally, this is a trend that still has room to grow. You can see on the far right how it's changed over the past 5 years from cash to card or cash to digital. And this is a very consistent growth. And one of the unique things, financials, it can be quite sensitive to the macro picture and sensitive to interest rates. But these themes, this transition from cash to card, it's far less correlated, relative to traditional financials. So you have an area where you can play, this growthier theme that still has plenty of room to run, and it's far less correlated to the macro picture. So to conclude, and I'll cover one last slide, and then I'm more than happy to open it up for any questions, just to recap, our offering in the 3 sectors we talked about today. So to run through them very quick, if you're looking for growth and innovation, look at technology. And the BGF World Technology Fund, it's a diversified approach investing in many different, exciting emerging themes. Whether it's already more established, like cybersecurity or e-commerce, or it's very, new and niche, like generative AI, we're invested in it. But if you're looking for resilience or consistency of return, look at healthcare and the BGF World Health Science Fund, one of our longest running and most successful funds on the platform. Aaron's been running this vehicle for over a decade. And over that 10-year period, this is a fund in the top decile of risk-adjusted returns in the peer group. A phenomenal track record, delivering something that we believe most clients look to healthcare for. Risk-adjusted returns, consistency of returns, and that's what Aaron and the team has been able to deliver. And lastly, thinking of financials and also the innovation within fintech. We have the BGF World Financials Fund, based here in London. Very strong track record, outperforming year to date, 1 year, 3 year, 5 year. And it serves as a complement to invest in both some of the traditional financial names that are trading at massive, discounts relative to the global equity index, but also offering investors exposure to some of the innovation in the growthier side of fintech. All of that captured in one vehicle. So 3 different types of sector strategies serving 3 different purposes for different clients. But we believe all of them have the capabilities to generate outperformance due to our active approach in each of these 3 areas. So with that, thank you for the time, and I'd be more than happy to answer any questions that you may have on the line. And thank you for the time.
Thanks, AJ. That was actually very, very interesting. You touched on 3 topics. We would think they are so diverse, but at the end of the day, they're also correlated one next to the other. So starting with some questions that are coming in, especially in view that we have the US election coming up. How does government regulation and healthcare policy affect the investment decision within the healthcare sector? So what are you foreseeing there?
Yeah, great question. And you probably could tell by my accent, I'm American, so this one hits close to home. Look, every U.S. election cycle, many politicians look to healthcare as part of their platform for potential reform or changes, and more often than not, you'll often hear politicians, making, claims that they're going to, introduce, drug pricing reform and big transformational changes. But more often than not, and I'll use a quote that Aaron uses sometimes, it's a lot of thunder and not much rain. It's usually a lot of noise without much impact. And that's what we expect in this election. But with that said, keep in mind there's already been, some drug pricing reform as part of the Inflation Reduction Act, last year. So there have been some changes. And that's why we think it's very unlikely that we see even more transformational change on the horizon. So it's likely to be a little noisy. You'll probably hear as the election gets closer, people talking about healthcare and potential reforms, but more often than not, it's usually more thunder than rain. So we really don't foresee any significant risk on the political or regulatory side for healthcare as we approach the US election.
Okay, thank you for that. Another question coming in. Sorry about this. So we have an attendee who would like to hear some thoughts on how long interest rates will remain at these elevated levels.
Yeah, it's a tricky one. That's the golden question, right? Rates at these levels. Look, I think it requires a big disclaimer saying, subject to change, and it really depends on inflation. And will we see inflation come down, or will the Fed or the ECB force to keep having these rate hikes? We believe over the longer term horizon, let's say 12 to 18 months, we will get to the point where we hopefully we'll see some rate cuts. I say hopefully, especially more on the tech side. But a lot of this is still to be determined. It's something that we're very closely monitoring. I would say it's more likely than not that rate cuts won't happen until at least the later part of this year, if not even later. But that's our view on the rate environment. It really depends on inflation.
Thanks. Matthew, I don't know if you want to take the next question.
Absolutely. I think it's a very important one on financials. So obviously we've seen at the beginning of the year some financials performing, or at least looking to perform rather well, and then we've seen some turmoil back in March on a number of the big names. I mean, what's the current environment over there? What do we expect in the coming months? Of course, the interest rates rise obviously help financials broadly, but of course, when clients approach this topic, they'd like to understand what's happening and what can happen beyond the turmoil and possibly the good performances so far seen.
Yeah, it's a great question, and one we get quite a bit. Headed into the year, as you mentioned, Matt, financials were a hot topic. There were inflows coming into the category. People were very excited, higher rate environment. And then we had, as you mentioned, some turmoil. It was really a run on the banks with Silicon Valley Bank and then Signature Bank. And this sent a pretty big scare, throughout the industry and for the whole sector, especially amongst U.S. regional banks. It's our view that the actions taken were prudent, to protect investor deposits, and same in Europe with UBS and CS. And we really think that we don't foresee any significant contagion, beyond what has already happened. So we do think things have calmed down considerably. And the one area that we're probably the most excited about from just a straight opportunity standpoint, it's European banks. European banks, which, away from the US, so further away from SVB or Signature, but these banks, and I mentioned that valuation chart, European banks are trading at even a greater discount than that. So you're talking about a discount, nearly 40% or more relative to the MSCI ACWI, and a very favorable, interest rate environment for them. Even if maybe we're towards the peak of rate hikes, still operating in a higher rate environment, as we've seen from the earnings, which has been quite strong, is good for European banks and European financials. It's actually our biggest overweight in the World Financials Fund. So in short, we think the worst is behind us, especially from those disruptive events in March. And we're forward looking. European financials is by far, our most favored area within the sector.
So continuing on financials, AJ, we have a question. Do you think there's more potential in the traditional banks or more in the fintechs that are coming up in this space?
Yeah, good one. I'll keep it pretty short because the answer is a bit of both. We have a bit more of, not technically a barbell, but a little bit, where we are overweight many of the traditional financials like the European banks that I mentioned, but we are also overweight US fintech. The area that we're underweight is kind of the areas that are in the middle, defensive insurance companies, especially P&C insurance companies, which aren't as geared to rates. We've also moved away from some of the US regional banks, as they're still facing some potential increased regulation following the events in March. So in short, it's a bit of both. Traditional European financials, US fintech.
Can I hear Ingrid, just in case you have any other questions? I actually have one for AJ going back to technology, one of the hottest topics that has been for quite some time. It is still a core allocation of our portfolios, perhaps in a gradual approach, given how much they are changing the way we invest. As such, one of the big topics is, of course, investing in semiconductors, especially in the CHIPS Act. Do you think there's going to be any sort of impact, not just for the fund itself, but especially on the theme? How does this impact not just the production of semiconductors, but most importantly, the onshoring theme, which is another especially important query that most of our clients ask?
Definitely. Good question. And look, semiconductors is one of our biggest exposure in the fund. And the CHIPS Act that you alluded to, you're talking over $200 billion in funding, to bring on more semiconductor capacity in the U.S. It's a massive, massive number to think. But to almost take a step back, why are we doing this? To own those supply chains. Think as a reminder, semiconductors is the fuel for many of the themes we talk about in tech. Whether it's generative AI, whether it's electric vehicles, semiconductors is a crucial component. And that's why we're very much overweight and positive on the sector. And that CHIPS Act, it just makes it even better, for us as investors and the opportunity. And Matt, maybe one extra thing I'll add on to that is you've seen many of the names in the semiconductor space that are tilted, towards generative AI have done phenomenally well this year. And we expect that to continue. We've seen it recently on the most recent earnings without specifically giving a stock example name, but you've seen a material impact from generative AI. And keep in mind, we're still in the early innings on this theme. So we continue to have very high conviction in this area.
So some other questions coming in. The failure of US banks and Credit Suisse in Europe, do you think that they can negatively affect the IT sector and the fintech sectors in particular? So here we're combining two themes we actually were talking about.
Yeah, interesting. So I think if I understand the question right, if the big financials, if they can be the disruptor or be disrupted by tech, if I understand it correctly, we believe it could be a bit of both. One, the big names, and I'll actually maybe use a different name, think about JP Morgan in the US. They spend over $10 billion a year on tech. They have vast resources and a commitment, to be more of a fintech. They also have a huge payment space and digital banking, platform. And then of course you have the pure fintech names, maybe like some of the neobanks, the branchless banking model. We believe both can work. So the big ones that are big enough to invest in technology on their own, and the smaller, faster growing ones who are pure play. The ones that we have more of a negative view on, the ones in the middle that may not have the funding themselves to invest a lot in tech, but they're also too established to consider themselves or pivot into becoming a pure fintech name. So it's a little bit of both. The established names, they're still in a good spot if they're investing in fintech. If they're not, it's going to be a challenge because consumers, they want the best tech from their financial services provider.
At the moment, we're all hearing a lot about a potential threat of a US default. So what are your thoughts about this and the impact that this might have on any of the sectors we were discussing today?
Yeah, good question, and very topical. And we'll see what happens, right? Depending on whether you're watching live or on the recording. A default would be tough for all of equities, and the most impacted would probably be the more cyclical sectors, probably tech or financials. The one that should be more immune. I should be careful with the word immune because if it affects all of equities, it includes healthcare. But it would probably be healthcare because healthcare has more of that resilience, and the broad fundamentals of healthcare really shouldn't be nearly as impacted. So it's very tough to say, and we'll see what happens. But healthcare, because it has more of those defensive, resilient qualities, should likely fare better if we see a default.
Okay. So, last two questions, AJ. So, how do regulatory policies and intellectual property consideration affect technology investments?
Yeah, fair question. Well, it's all about IP and protection. And I think part of that onshoring, reshoring thing, that's also what it's about. It's bringing it onshore. I think the biggest example I'm thinking of IP and protection, it's really thinking about U.S. and China, and the way we're thinking of it from an investment perspective. We're invested in both areas, knowing that Chinese companies are going to make a move to ensure they're utilizing Chinese software for their products, having a complete China-based supply chain. U.S. is doing the same. We believe there's going to be a significant bifurcation. It's all goes back to kind of that reshoring, onshoring theme, and it's the same with IP and knowledge, and that's one that we don't see reversing at all. So we believe it's probably most prevalent to China, and always keeping in mind and some of the beneficiaries. For example, one of the companies that we've invested in, they're in a China-based software company tailored to the construction industry. Well, why do we do that? Well, we believe any national construction product in China, they're not going to use a US-based software provider. They'll want to use a national one. So it actually could breed more opportunities for us as investors, and it's something that we continue to see as a theme.
Okay, so as to our last question, so within the technology sphere, which sector or sub-industry do you think that presents the best investment opportunity at this point in time?
Yeah, good question. I probably mentioned it too many times already. Semiconductors is a big one. Semiconductors is a big one. It's a fuel to so many themes. We've seen great earnings from some of the big companies. I would also say software is one of our biggest exposures, but maybe to tailor it a little bit, and it's aligned with software, but where we see some of the best near-term opportunities, it's really invested in many of the mega caps. Many of the mega caps, they made moves earlier in this year to really take actions to become more efficient. Lots of cost cuts, lots of headcount reductions. This is also the area of the market, the mega caps, that have the capabilities to invest a ton in generative AI. Microsoft is one of the more direct plays on generative AI. So to tweak the question a little bit in areas, definitely software and semiconductors as industries, but also from a portfolio context, we believe the mega caps certainly look quite attractive because they're very much aligned with some of the themes that we're really excited about over the long term.
Perfect. So AJ, Matthew, the whole team at BlackRock who helped us make this a success. Thank you for your time today and for all the information you provided and you shared with us. I am sure that we all found it very interesting. A big thank you also goes to all of you who joined us today. Our team of advisors are available if you have any further questions, and any more information on the funds discussed can also be found on our website. Nice evening, everyone, and thanks again, AJ and Matthew.
Thank you.